Now that you're comfortable with your down payment amount, we're going to answer the final question. If you spend what the bank tells you that you can afford, will you still be able to fund a great life and retire at a reasonable age? To answer this question, we're going to be using the numbers we generated in Ratehub's mortgage affordability calculator to enter into ES Planner and create our home buyer scenario. It's at this point in the presentation where we find out how your proposed home purchase fits into your financial future. When you're ready, let's jump back into ES Planner to make the necessary changes to the information we entered earlier. Moving back to the first step in the process, when we assessed your current financial situation, we won't be making any changes to the family information, so hit next once you're ready. We also won't be amending your retirement age or your earnings, so let's hit next to keep moving. We'll need to draw down from your regular assets to fund the closing cost for your home. And in the case of Michael and Michelle, we budgeted $25,000 from the $30,000 that they had available. If your down payment is sitting outside of your RSP or TFSA, you'll also need to adjust your account balance here to suit the amount you intend to draw down. We'll also be adjusting your RSP and TFSA balances on the next slide. Michael and Michelle used their combined savings of $100,000 from their RSP and TFSA to fund their down payment. So I reduced these balances to suit, and you can do the same. I've left the remainder of the savings schedule as is, and unfortunately the free version of ES Planner does not seem to have the capacity to model the repayment of the RSP home buyers plan. However, as each of them are already contributing $7,000 on an annual basis to their RSP, part of this amount would go towards repayment of the home buyers plan over the first 15 years until it's been paid off. I used Wealthsimple's recommendation of saving 20% of gross income in generating the savings contributions for Michael and Michelle, and you may find that such a high savings amount is difficult to accomplish while you're also paying down the additional costs associated with your house and mortgage. The free version of ES Planner is not able to model a change in savings rate over your lifetime, so if you need to make some amendments to suit your budget over the first few years, your financial planner should be able to take this into consideration and model your scenario accordingly. If you're not currently working with a financial planner and you're looking for someone to help, give me a call and I can recommend a few that I know and trust. Again, we won't be making any amendments here, so hit next once you're ready. Here is where we'll be making the majority of changes to suit the home buyers scenario. First of all, delete the data that you entered into the rentals section, then refer to the numbers you generated using Ratehub's affordability calculator, as we'll be entering them here. You can enter the total affordability calculation under the current value, then enter the total mortgage balance including any CMHC fees under the mortgage balance. Michael and Michelle had a mortgage amortization period of 25 years, and if you had less than 20% available for down payment, I expect this will be your amortization period as well. Now enter your monthly payment as per Ratehub's calculator. Then be sure to multiply your monthly property tax by 12 to calculate your annual property tax. And do the same for your annual homeowner's insurance. I entered the remaining expenses, phone, cable and internet, into the final box once I'd multiplied them by 12 to get an annual figure. Then I added a buffer of 0.5% of property value for ongoing maintenance. Some sources suggest budgeting 1% of property value on an annual basis. However, I figured that we'd likely already over budgeted for property taxes, so we could use that buffer for maintenance costs if necessary. If you're unsure, do whatever you think is best to suit your situation and risk tolerance. Once you're comfortable with your entries, hit the save button. Since we won't be making any additional changes, you can now review all the inputs for your personal information, earnings, and regular assets, as well as your retirement account rate of return, withdrawal schedule, current assets, and contributions, as well as housing expenses, college expenses, other expenses, and your withdrawal schedule for the Canadian or Quebec pension plan. Once you're comfortable with all the inputs, you can hit the button to create your plan.